You very much for once again adding some or allocating some valuable time from your busy schedule to talk us through what has been once again a very interesting year. We've seen some ups and downs in terms of markets globally in 2021. Pierre, we saw the US and emerging or developed countries dominating once again. But then again, we also saw some light, shining towards the emerging economies, including ourselves, where we saw some stimulus in our local South African market. China didn't do as well. But would you mind talking us through how you guys have interpreted what happened in 2021, and just give us some context in terms of the numbers that we've seen coming through?
Thank you. Thanks for the opportunity. You gave a good introduction. I think the most instructive graph for me is the one that I'm projecting at the moment, which shows 4 index lines. The green line is the US market, and this is for the calendar year 2021, so it's what happened last year. The green is the US market, the blue is China, and then the other 2 lines, the gray and the red, is respectively the MSCI World Index, if you take the US out of it, and the MSCI Emerging Markets Index, the red one, if you take China out of it. And this illustrates very vividly that the performance was really in the US to a very large degree last year. China, as you mentioned, didn't do well, and that was mostly self-inflicted. So they cooled down their economy because they were a bit worried previously about credit extension and the property market. So they cooled down the economy, and they brought in, as you might know, quite a bit of regulation around, what banks can do, what private education companies can do, what gaming companies, online gaming companies can and can't do. And that has all to do with their political and their social construct of what they're trying to achieve in China on a longer term future. So we think much of that pain has been taken, and we're actually quite optimistic about a rebound and a prognosis for China. And maybe later on I can show you that the credit stimulus, which shows the direction of credit extension, which is good for economic growth, has turned in China. So that's one point. The other point is, if we look at our portfolios and the managers we use, where a manager was positioned had a material influence. So if a manager was underweight the US, he didn't do as well as the green line. He kind of got the red line. And again, if you had some exposure to China, you typically lagged. And that includes managers like Coronation. They were hurt by their EM exposure, by their China exposure, by their overweight to Naspers, who also were impacted by China. Another manager that was influenced is Ford, Alan Gray, and Orbis to a degree. And therefore, we expect all these managers to come back fairly strongly if our prognosis for China is correct. South Africa actually did quite well last year. This is a dollar graph. So if you think about the all-share index, in Rand terms, the all-share did about 24%, but the Rand actually weakened. So from the perspective of a dollar investor, if you were to put it on this graph, the SA line would be somewhere between the green and the red and the gray, because you would get 24% minus the 8% Rand depreciation, which takes away from the returns of a dollar investor. So we actually did quite well. We did somewhere between the green and the red. And the main reason for that is strong resource prices. We gained from strong resource prices and good exports by our mining sector, and that helped our fiscus, and it also helped our inflation rate. So and our tax collections, as you know. So all round, we had the benefit from that. And we can talk about it a bit later, but we're also quite positive about SA valuations. They look better than the rest of the world. So we also think going forward, there's probably a good story for SA market investments for the next number of years, compared to, for example, a US market that is much more expensive. So that's not to say you don't want to invest in the US. There's obviously many other opportunities available there that's not available in South Africa, but we think overseas good active managers will be important, because you'll have to be selective, because those markets at the headline level is quite expensive from a valuation point of view.
I think that brings me to my next question, Pierre, and you're actually spot on in that regard. So we saw the US markets reacting very emotionally, or very swiftly rather, as possibly a better description, towards what was expected to be a lower inflation number coming through, and that's now surprised. Markets reacted even though we sort of anticipated those figures coming out. Even though, yeah, I mean, and there is a bit of a higher number that actually came out, and which spooked markets. We saw that, and that then backed up directly by geopolitical risk in terms of the Russian-Ukrainian debacle. Do you want to just talk us through how we interpret 2022 from that perspective, in terms
Yes.
of, one, global markets being, as you pointed out correctly, fairly priced, quite expensive in that regard, and possible opportunities being quite limited, and how do we see South African market and emergings playing out relative to that?
Yes, good. Thank you. Very good points that you made. The markets, as we know, was not good in January. Specifically, globally, South Africa's market was kind of flat in January, but in dollar terms, the US fell about 10% on average, depending on which index you look at. And you're absolutely correct. The market was spooked by two things. It was spooked by inflation that is currently very high in the US. So their recent inflation print, as you can see on this graph, is now at 7%. And obviously what the market is concerned about is that this high inflation will lead to much quicker interest rate increases in the US and to higher bond yields, and that will be bad for the valuations of shares. Now, we think what's going to happen with inflation is that it's going to peak in the first quarter or the second quarter of this year, and then dramatically start coming down. And by year end, US inflation will probably be in the 3 to 4% range. So it'll be higher than pre-COVID, but it'll be somewhere along this kind of stylized gray dotted line on the graph. So, all from the 7% highs and at a much lower level. The Federal Reserve will start raising interest rates, but the important thing is we are coming off very, very low interest rate levels in the US. And that you can see on this graph that shows the US Fed funds rate, the federal funds rates, which is currently at a guidance of between 0 and 0.25%. And it's really been there for the last decade since the financial crisis. There was a small effort to increase rates in 2017, 2018, but they quickly had to cut again when COVID happened. Now, what this ultra low interest rates mean, in our view, is that if you look at the interest rate cycle, we are still in the early stages of that. And market evidence or research shows that the equity market actually does fairly well in this first stage of the interest rate rise cycle. The equity market really only starts reacting negatively when interest rates get above what they call the neutral line. So the neutral line is really where the interest rate is at a neutral setting, where you have full employment in the US, or as close to full employment as you can get. And it's neither deflationary nor inflationary. Now, just try and keep these numbers in mind. The US neutral interest rate is somewhere around 2%, between 2 and 2.5%. Currently, they're at 0. Before they get to the 2% level, we're still in this first phase, and this first phase is typically a phase in which equity markets still do quite well. So that's a long story just to make the point that we think to go very conservative now and underweight exposure to risk assets and equities will be too early. There's probably 12 to 18 months from now before interest rate rises, even if they start in March, will start having an effect on the market. We will have higher volatility because inflation is high. And as I told other clients recently, we're currently at peak uncertainty as far as inflation is concerned, and also as far as the actions of the Fed is concerned. And what I mean by peak uncertainty is that we have a strong suspicion this inflation rate is going to roll over and come down by mid-year because of base effects and a few other reasons. But the signs of that is not there yet. So it's really peak uncertainty, and hopefully after 6 months from now, we'll have some more certainty about the direction. And the same goes in terms of the actions of the Fed. We and the market had to very quickly adjust to the change in the message from the Fed in the last 6 months, because 6 months ago, the Fed was saying inflation is not a problem. It's going to be transitory, and we think we're only going to increase interest rates in the US at the end of 2022 and into 2023. 6 months later, where we now, they've turned around and they're saying, no, we were wrong. Inflation is a problem, and we're going to start increasing interest rates in March, and we might actually start with a 50 basis point increase. So they really want to make their first hit the hardest to get that message across to the market that they're not going to get long-term inflation expectations, let it get out of control. So we think there's time until inflation increases kind of really have an effect on the market. So we want to be neutral. So we don't want to be overweight, because we can see there's going to be volatility this year because of peak uncertainty. But without predicting, what we actually think might happen is significant volatility in the first half of the year, and then come the second half of the year, and the inflation rates start rolling over and coming down, that the Fed actually then take their foot off the brake and they start messaging a bit more dovish again. And then the market actually might react quite positively to that, when there's kind of that release of pressure from peak uncertainty. So we need to balance all those things, and therefore we think a neutral setting towards equity is correct, whatever that means for a client. In a balanced portfolio, for us, neutral, a pension fund portfolio, neutral to us means 60 to 65% equity exposure, local and global combined.
Okay, so from an emerging perspective, so we spoke about the possible upside that's still on the table in developed. From an emerging perspective, how does that play out? So you mentioned a neutral stance in terms of growth assets. Would you like to define that specifically? And maybe, if you wouldn't mind, I mean, so historically we saw currency following home as soon as you see an interest rate hike. So how would that sort of stimulate current valuation in the dollar? We're seeing a fairly strong rand relative to the dollar at the moment, or maybe a weaker dollar towards the rand rather. So do you want to just elaborate on that a bit more?
Okay, great. I'll come back to the matter of currency, but let me quickly talk about China as the most important component within emerging markets. And let me show you some valuation charts. So this slide is on China, and really what I want to show is at the bottom left-hand side, what's called the credit impulse, and it really just shows you the direction of credit extension in the economy, in the Chinese economy. And obviously when the line goes up, they're pumping more credit into the economy, and that's good for economic growth. And when the line is coming down, they are withdrawing it, and therefore the economy is cooling. And you can see that has turned, and it's pointing upwards, and it's going into the positive territory. So this is positive for Chinese economic growth, and therefore we think that's going to be positive not only for Chinese economics and markets, but potentially also for other emerging markets. If we look at valuations, very quickly, 4 snapshots. We look at PEs, price earnings ratio. It's a ratio that tells you whether a market is expensive or cheap. If the line is high, the market is expensive. If the line is low, the market is cheap. You can look at many other valuation metrics, but this is a forward PE, so it looks at what earnings is expected for the next year, and it gives you a reasonably good idea of where market is valued. This is the S&P 500, the main index in the US. It's expensively valued, and therefore I said, it's not to say you should not invest in the US, but maybe an active manager is important, because you'll have to be selective on where the good opportunities are. Buy the cheaper shares that will give you good returns going forward, and avoid the most expensive shares that might not have much room for disappointment if their earnings disappoint. This is the same valuation graph for the UK. It's at neutral valuation, and it is just to make the point that there are other developed markets that are showing better value compared to the US, and Japan basically looks the same as the UK. So within the developed market complex, we are more keen on the UK, Europe, and Japan as overweights, and maybe a slight underweight to the US. The next graph is emerging markets as a group, which includes South Africa, obviously, and China as well. And overall, emerging markets is at neutral. So again, better valued than the US. And the next graph is China. The next graph is South Africa. And this is cheap. This line is cheap. So South Africa is cheaper than emerging markets generally, and it is much cheaper than the US. Now, again, one should not be binary about this. So we're not saying bring everything back from overseas and only invest in South Africa, because clearly we've got a fairly narrow market. There is good companies here, but there are many sectors and subsectors that are not represented in South Africa that you want to access internationally. But it is nice to see from a South African perspective that we actually have quite good value in our market. And we hear the same message from highly rated managers like Alan Gray, Coronation, and MNG, previously called Prudential, and they are pretty much at max in their funds at max on SA exposure, and they've been increasing their SA exposure. So I think that is quite positive. And then just back to your question on the currency, if we look at the rand, this graph shows the rand versus the dollar in the red line, and then the black line is the theoretical level of the rand. This is called a purchase power parity comparison, and the black line is a theoretical level of where the rand should trade against the dollar. And as you can see, the actual rand dollar, the red line, kind of moves around the black line. So sometimes the rand is too weak, sometimes the rand is too strong. It's at the peaks where it's too weak, and it's the bottom where it's too strong. And it can stay too weak or too strong for a long period of time, but the general tendency is to come back to the dark line. So interestingly enough, if you take economic fundamentals into account, then the rand is actually a bit too weak by anything between 10 and 15%, depending on which developed market currency you look at. If you look at the dollar, it's about 15% too weak. And therefore, we think if a certain scenario plays out of a stronger China helping emerging markets generally, commodity prices staying strong, then in time we might actually see that the rand being a bit stronger. But we don't necessarily think it's a theme for this year, and specifically for the first part of the year, because we think the fundamental changes that we're going to see is going to be pro-dollar for a while. And what we mean by that, as you mentioned, is US interest rates starting to rise in March, and European rates, for example, only rising much later in the year or at the end of year. So between March and the end of this year, the interest rate gap between the US and Europe is actually going to move in favor of the dollar. So we think the currencies, both the rand and the dollar, by and large, is probably going to trade in their current ranges this year, with potentially some volatility, but we would not think that the fundamentals, which would mean a stronger rand by 10 to 15% and a weaker dollar by 10 to 15%, will necessarily happen that quickly. So I think a rand at a rate of 15 is probably the range in which it might be for much of this year. And obviously it's a range, so that might mean 14.50 to 15.50, but we don't expect, if the rand from here blows out to 17 or 18, it'll bring it again to those peaks where it never stays. So, based on this graph, if the rand weakens significantly from here, it will not be the time to rush out of the country with money in buckets, because from there onwards, the rand typically comes back a bit.
Fantastic. Pierre, once again, this was very informative and I think right to the point. Thank you for the context and the way you approach these sessions. I really appreciate. It's always a valuable discussion. So thank you for your time.
Thanks a lot. So
I'm happy to catch up soon.
I think my parting words will be stay committed to the market for the time being. Be prepared for some volatility this year, but I think if we ride it through, there's maybe a bit more in the equity market in the next 12 to 18 months.
Once again, yes, and as I mentioned historically as well, I think proper diversification and proper, well-built portfolio, robust with a global mandate is relevant now more so than ever, as you correctly pointed out. Thank you so much for your time once again. I really do appreciate your effort.
Pleasure. Go well.
Thanks, Pierre.